So today we are going to discuss reading number 6. Now, reading 5 and 6 are what are known as bonus readings, because questions related to these readings are relatively straightforward and easy to answer, and you can easily score marks in these two readings. Hopefully, when you'll be practicing question, you'll also be able to achieve 100% accuracy. There are certain readings that are difficult to understand and therefore difficult to score. These readings are not like that. They are very calculation oriented, and they are specific concept. If you understand those concepts, you can be comfortably scoring 100% questions. Now, approximately number of reading is what? For level 1, it is this time 60 something. 60? 64. And you have 240 questions. So approximately every reading will have four questions. 240 divided by 60, 4 questions. So these two readings, reading 5 and 6, will give you opportunity to answer 7 to 8 multiple choice questions in exam. Now the reading name is Discounted Cash Flow Application. So in the previous reading we learned what is a discounted cash flow. Now we are going to apply it. What is the use of this? Who gets benefit from it? Let me give you a hypothetical scenario. Let's say you can invest in a project that is likely to provide you with cash flows of 500 here and 500 here and 500 here. Question is, should you do it or not? As an investor, obviously, you will be the financial advisor to some investor who will be looking at this as an opportunity to invest or not invest. Now, anyone who has money, a rich guy, generally wants to be more rich. So what he wants to do, and he does not want to work for it. All he wants to do is give his money and then get back money with the more additional income on it. So, obviously, you do not want to invest money or give money to someone where the money comes back without any additional benefit. Obviously, the most safe investment is money can be given to a bank for 3 years. And then, after 3 years, money will come back with something additional. Now, this is a project that has these cash flows provided. We expect to receive cash flow of 500 in year 1, 500 in year 2, and 500 in year 3. This project requires that investor should invest 1100 at time 0. I'm using parenthesis to indicate a negative sign to indicate the money should go out. So this is a project that we are evaluating, that should we invest in this project or not. We are going to use discounted cash flow techniques to conclude that we should or we should not. Now, think of a typical trade. Should you trade? Should you purchase something for 10 and sell for 12? Yes, because purchasing something for 10 and selling for 12 provide you a profit of 2 rupees. It is not simple as that. We cannot just say that by investing 1100 we are earning 1500. Oh, yes, that's correct. By investing 1100 we are earning 1500. But is it a profitable trade? The problem is that the 400 that we are earning over 3 years. Now, if it was a right now invest and get money trade, that you invest 1100 and you collect 1500, you should do that. But there is a time delay. You invest now, you are collecting over 3 years, and you know that the money coming in future is not same as money now. What you are giving is money now money. What you are earning is future money. Now, future money has a couple of problems. One is it is uncertain. There are chances that you may not get it, and you may get less than that. While the money now is a current amount of money that is, so what is going out is for sure. What is going to come in is not for sure, so there is risk involved. Question is, how in this such situation can we say this is a good trade, we should do that, we should invest 1100, and obviously numbers are small, and you can just multiply with a couple of millions and you get the real story where someone is investing. For example, if you go to Georgetown, you find this Nishat hotel being constructed. Clearly, Mansha is investing a lot of money now in the hope of generating a lot of money in future. So this is a typical investment problem. This is regarding not just the real estate project, this can be about anything. In stock, you can purchase Unilever stock for 1100, should you purchase or not? I had a similar situation a few years back. Uh, this is a very regular CFA problem. X amount of money is going out, Y amount of money is coming in. Should you do that or not? Now, simply adding won't work because then we'll be adding future money into the current money. That is not fair. Future money needs to be first converted into current money by cutting it down, by discounting it. So we are going to say this 500 coming in year 1 not 500, it's 480 or 470. Why it is not 500? Because it is in future. So we will calculate present values of these three numbers at time 0. And that would be the present value of inflows. Present value of inflows. So PV of just the inflows. And once you deduct this 1100 from that, what you get is net. Net is a term that is used extensively in finance. That means something has been deducted from something to get this answer. Net present value or NPV. Now, if this is positive, then we should do this project. So this is one application of this kind, that you calculate net present value, and if this is a positive number, that means that in today's term, the inflow is more valuable than outflow. Now clearly you must be thinking, what is the rate to be used to calculate present value? That will depend. That will depend on many factors. First of all, how sure you are about getting 500. If you are not sure, then you will use a higher rate. So if there is more risk, if there is more risk in the business, you will use a higher required rate of return. We'll talk about that in corporate finance. What rate to use and how to find that rate. At this stage, you'll be given a rate, a discount rate, to use to calculate present value. Let's say the discount rate given is 7%. Obviously, you can do the calculation and you can find NPV, 7%. Now, how to calculate present value? Well, you can do many ways. One is you can use 500 as payment and 3 as N. You can compute present value and then you deduct 1100 and you get the net present value. But there is another way to do that. The benefit of that is that this second method will work even if these numbers are not same every year. Remember, the payment function works if you have same amounts every year. But what if it is 500, 600 and 700, something like that, uneven cash flows? Even in that case, the formula, this method will work. So I am modifying the data. Instead of 500, 500, 500, the data is like this, that there is 600 and then there is a 350. Now sometimes you can answer the question that whether NPV is positive or negative without discounting. In this case, can you do that? Will NPV be positive or negative number? Can you answer that without discounting? It is difficult to answer. But what if numbers were now, can you answer NPV is likely to be negative or positive? Negative. Because even without discounting, you are only getting 900. 300 plus 300, 300. So definitely NPV will be negative in that case. But anyway, so this is just one way of the exam question that can be there. Sometimes discount rate is not given and you are asked whether NPV is negative or positive. Now student is looking for the discount rate, but discount rate is not given. So student thinks the question is wrong, there is a mistake in the question. But point is, if even without discounting, future cash flows are less than the outflow, then NPV will be negative because once you discount, you will bring it down further. Whatever is the rate, even if it is 1%. Anyway, so let's learn how to calculate NPV for this type of a problem. In your calculator, okay, you need to turn it on. We are going to use a worksheet that goes by the name cash flow worksheet. So that worksheet needs to be activated first. For that, you need to press a button which is CF. This button is CF. If it is close to the second function, just press CF. And now your calculator must be displaying CF0 and then 0.000. Basically, the calculator is saying what is cash flow at time 0. CF0 is cash flow at time 0. Now you know that is 1100. So 1100, type 1100. No, you first type 1100 and then we make it negative. 1100 and then there is a sign next to the decimal which has a positive and a negative sign. You press it. So now this 1100 has become a negative 1100. Yeah. So you have just typed it. You have not informed the calculator that you are done with typing. Calculator is waiting for you. Probably you want to punch another 0. So calculator is not just registered yet. What you need to do is press enter. There is a button at the top. Enter. Now this cash flow of negative 1100 has been entered as CF0. Okay. Now there are two arrows up and down. Press the down arrow. Calculator says C01, which is cash flow at time 01. We have 500. So 500 and enter. Press down. 600. Enter. Now hold on. When you press down, your calculator was displaying not C02. It was something F01. At this stage, just type 1 and enter. F01 should be 1. F1 and enter. I'll explain what is F. So just 1. Type 1 and press enter. It will replace with whatever you have already typed. So 1 and enter. And now you press down. It asks for C02. Now you are going to type 600. 600 and enter. And you press down, it says F0, ignore F. Press down again. It says C03. Now this is 350. 350. Enter. That's it. You have provided all the cash flow information that the calculator needed. All you have to do is ask the calculator to calculate NPV. There is a button for that. NPV. Press that. And the calculator says, what is the I? There is a button of NPV. Just press NPV. What is I? Because in order to discount, calculator needs to know rate. You know the rate. 7, type 7, press enter. Now press down. And NPV is 0. That is where you press the last key, compute. Just press compute. And you got the NPV, which is a positive number of 177. Okay, very good. Do not worry absolutely about how to do it, because not only you have that in the book how to do that. If you have skipped a step, it's fine. You have all in detail in that how to use the calculator, and also you get the video to review it. So we are done with the calculation. The rule is, if NPV is positive, we should do the project. There it goes. But some investors do not like NPV. Though, as a professionals, we believe that NPV is the best method. But some professionals look at it, or look at this problem another way. Think of this. Now, if I can earn 11% from some investment and I can borrow at 7%, should I do it? Yes, because my cost of money is less than the money that I'm making. So sometimes investors ask this type of question: how much we are making in this project? Our cost of money is 7. We are getting money at 7%. How much are we making in this project? So to answer this question, how much we are making, any investment that has these cash flows, how much we make in this, we calculate something called IRR, internal rate of return. And your calculator can help you in doing that. The theoretical understanding of IRR will come in detail later on in corporate finance, but at this stage this focus is whether you can calculate it or not. Now, for the same project, the calculation of IRR is simple. There is a button for that. You have already given the information, so you do not need to provide again. I just press IRR and compute. And the IRR is 16.06. Now, let's make sure that we understand the interpretation. This is the return that you get from the project. The word internal is attached. So just looking at the project, you can say this project is providing return of 16%. Is it good? That will depend. That will depend on the cost of money, the rate at which you can borrow. If you can borrow at 20%, you should not do this project because your money is expensive. The cost is more than what you are getting. But if you can get money at 7%, you should do this project. So that's where the IRR rule comes in. The investment rule comes in. Decision rule for IRR is if IRR is greater than R is here the cost of money. In our case, 7%. If IRR is greater than 7, your cost of money, accept the project. If IRR is less than cost of money, then reject the project. As you can see, IRR can be calculated for any series of cash flow. Let's say if our outflow is 400 and we have inflow of 150, 250 and 175. Let's calculate IRR. What is IRR of this project? Now first step is you need to clear whatever for that you need a new combination. So yesterday's combination was only for TVM, third row. You are not using the third row, you are using the second row. So to clear that, first step is activate the sheet CF. So press CF. Now press second function and then at the left bottom CE. C/C. Yeah. This combination is used to clear the data in cash flow worksheet. This is the difference than the yesterday's one. So you have just cleared the cash flow worksheet. Now type in the numbers provide as input and calculate IRR. 400 negative is your cash flow at time 0. So 400 and then press the button positive negative to make it negative. That would be your input. So IRR. For IRR, you do not need interest rate. You press IRR, you press compute. 19.99. Right? Okay. 19.9? 8. Okay, 8. So this is the IRR. And the interesting thing that you have learned is you do not need the cost of money to calculate IRR. That is why it is called internal to the project. This has nothing to do with the investor. This project offers return of 19.98% to anyone. Whoever decides to do this project will earn 19.98% by investing 400 and earning this. Now who is going to do that? Anyone who can get money, who can borrow money at less than 19.98. If someone can get money at 15%, he should do this project. If someone can get money at 25%, he should not do this project. So the benefit of IRR is, or the disadvantage, well, IRR ignores who is the investor and whether he is getting money at a higher rate or lower rate. You can understand different investors can get money at a different rate. Now, Manisha can easily get money at a lower rate than you and me. If I decide to invest in something and I try to borrow money, I'll have to pay a lot more as a cost of money. So IRR is independent of that. IRR is just internal to the project. It says this project offers return of 19.98%. Whoever is willing, one can invest. So we have discussed NPV and IRR. Now there is an interesting thing that if you calculate NPV of this project and you discount these cash flows, obviously for NPV, you discount these cash flows and then you calculate NPV. If you use IRR to discount cash flows, you will get NPV of 0. And there's a logic behind it. It's very simple. That's all you can try that. Just focus on that. What is going on? The project offers 19.98%. If your cost is 19.98%, then you should net earn nothing. That is what the idea. The project is offering 19.98%. If that is your cost, then the net present value, which is basically the number that says this is what you are going to earn over and above your cost. You are going to earn nothing. Your cost is 19.98%. The project is offering 19.98%. So that's why this line is here that says the discount rate at which NPV is 0. So IRR is the discount rate at which NPV is 0. Or we can say the rate at which present value of inflows is equal to present value of outflows. Now, we need to understand the concept of independent projects versus mutually exclusive projects. Now, should Mia Mancha construct a hotel, and should Mia Mancha expand the cement plant, they are independent decisions. They are not related. They are not mutually exclusive. Mutually exclusive is you can either do one or the other. Sometimes decisions need to be made. For example, when one had to decide about conversion of the cement plant into coal power or furnace oil based or natural gas based. So the source of power decision is mutually exclusive. Either you go with coal based power generation or you go with oil based power generation. You cannot do both. So you have to choose one. And same can be, I was once involved in this. Coca-Cola had to face this problem that they got interesting investment opportunities in a couple of countries, but they had limited funds to invest, so they had to choose which country. So that was a mutually exclusive. Now both countries are offering, Pakistan and India were offering good opportunities to invest. They were offering good returns. Which one to choose? Perhaps you could not invest in both. Coke had a similar problem earlier, but anyway. So if you have two projects and you have to choose one, which one? Now that is where sometimes if you use IRR, you may go one way. If you use NPV, you may go other way. It is possible that if you use IRR to select the best project, you have a project that says this is good because it has high IRR. This project is bad because it has low IRR. Now you try to do evaluation based on NPV, and it turns out this one has low NPV and this one has high NPV. This is known as conflicting results, which can be there. We will discuss it in a lot more detail in corporate finance. In corporate finance and investment, we'll talk about this, why it happens, and what is the solution. But at this stage, it is good enough for us to know that whenever there is a conflict between IRR and IRR is saying do this project, NPV is saying no, do this project, listen to NPV. Follow what NPV is saying. Select the project with the greatest NPV and not the greatest IRR. That is incorrect. And I understand you would like to know more about it. We will. It's a very interesting discussion. We'll do that in corporate finance. I'm making a statement and you need to be alert to agree or disagree with it. All projects that have positive IRR should be undertaken. Correct or incorrect? All projects that have positive IRR should be undertaken. Incorrect. Very good. Because positive IRR means what? This project is giving positive 4%. So, is it enough? That depends. Compare it to the cost of the loan. Okay, good. Now, there are certain problems with IRR. As I'm saying, we will come back to NPV IRR in corporate finance and discuss in detail. At this stage, it is just enough for you to remember that there are certain problems with IRR. What are these problems? That IRR will give you conflicting ranking. Ranking is identifying the best project. So IRR may give you conflicting. NPV and IRR may conflict. Just like these days, somehow our foreign ministry is experiencing conflicts coming from two people. There is one guy by the name of Tariq, and there is another guy by the name of Sartaj. And interestingly, I do not know, I've just read from some sources that the foreign ministry is confused. Who should they listen to? So sometimes investment advisor gets problem that he has ILR on one side, he has NPV on the other side. ILR is saying go and invest in project A. NPV is saying, no, forget about A, invest in B. Rule is, remember this, listen to NPV. Why this arises? Because of different size of initial cost or different timings of cash flows. So at this stage, just remember that these two factors can cause conflicting ranking. The significantly different initial cost or timing. We'll come back to it in corporate finance and you will get to know a lot more about it. Now, whenever there is news in the newspaper that OGDC, Oil and Gas Development Corporation, has found some oil well somewhere, suddenly the share price shoots up. Why? Because clearly, if they found oil well and they are going to spend X amount of money and they are going to extract oil that is worth 5x or 10x, that they are going to make money out of it. So if an entity goes for a positive NPV project, positive NPV, that's good for shareholders. Shareholders' wealth will rise. When Anglo decided to go for this new fertilizer plant, the decision resulted in the share price going down. Why? Because shareholders thought that this project is negative NPV project. They are not going to make money out of it. Turned out true. The Anglo is stuck with that fertilizer plant for which they do not have gas. And no wonder their CEO at that time is now trying to do certain other things than running a business. So key thing is, if a project decides to go with a negative NPV project, that will be destroying money. And that will be generally understood by shareholders, and share price will fall. So shareholder wealth will decrease. Now, if on the other side it's a zero NPV project, then company size will increase. Size of the company will rise. So previously they were doing projects of $400 million, now they are doing $500 million, but it won't have any effect on shareholders' wealth because net they are not making any money. This facts that you need to retain. The main topic area in this reading is this, and it's going to be quite time-taking. And make sure that you are following me wherever there is a gap. Take a note of it. As you know, you'll have access to the whole video. So do not try to worry about noting down or missing out something that I am doing. You'll have access to everything that I am doing. But try to focus on what I am saying and try to understand what is going on rather than worrying about just jotting down. Everything is explained in notes as well, so you won't miss any. I'm not going to provide you any new information. All I'm going to do is try to explain it in a way that it fits in. So focus on what I'm saying. Basically, we are going to learn about these two terminologies, MWR and TWR, and what they are. To give you example, let's say you are the portfolio manager, you are the fund manager, you are hired to manage money. In year one, you are able to earn 25%. Considered good return, but anyway, in the next year, you are able to earn, let's say, 10%. So over a 2 year period, this is your performance. Now, if someone asks you, how was your performance over the last 2 years, you need to give a number. That on average, I earned this. Number can be 25 plus 10 divided by 2. That can be one way of getting the average profit that you have earned. But this ignores the compounding effect. Because money that was invested in year one went up by 25%, and then the 10% in the second year was earned not on the original 100, but was earned on 125. So for that purpose, what we do, we calculate average in a different way. What we do is 1 plus 25% multiply by 1 plus 10%, all raised to 1 by 2 minus 1. This is arithmetic mean which we do not use. This is called geometric mean. This is what we use. The square root, this would have been 3 if we were talking about 3 years. It would have been 4 if we were talking about 4 years. So what do you get? So 1.25 multiplied by 1.10 raised to a square root. Your calculator has a key for that, for taking a square root, and then minus 1. And finally multiply by 100. 1.25 into 1.1. 17.26%. %. So this is a better average than the arithmetic mean. That would have been 17.5, 25 plus 10 divided by 2. That would have been 17.5, and that's not that good because it's not considering the compounding. So 17.26% is the average return over 2 years, right? Others get this number as well? Okay. So this is the way we calculate average performance. You can understand a lot of fund managers are in business for 5, 10, 20, even 30 years. So this is the way they do. They can say my average return over last 10 years is this. Now, I have provided you with these numbers. Sometimes you have to calculate these numbers. Let's see. Let's say I had provided you this information that a share was purchased for $10 at the time 0, and at the end of the year 1, this share price had gone up to $12, and this share paid a dividend of $0.5. Now you can calculate 25%. How? Let's see that. You can say 12 minus 10. 12 minus 10 is the price appreciation. We technically call this 12 P1 and we call this P0. And I can write this P1 minus P0. This is the capital gain. This is called price appreciation or capital gain. And then plus we earn dividend of 0.5, which is D. And then we divide it by the original investment 10. And you get 25%. So you may be provided exact 25% number, or you may have to calculate it with this information. It can be descriptive. A share was purchased for 10. By the end of the year, it went up to 12 rupees or dollars, and there was a dividend of 0.5. So the percentage return of year 1 was 25%. Let's try another example to make sure that you have followed the logic. It's a bit tricky, so you need to take care in the calculation. A share was purchased for $50 at time 0, so T0, T1 and T2. A share was purchased for $50. By the end of the year, this share had gone up to $60, and there was a dividend of $5. By the end of the second year, this share had gone up to 90, and it paid dividend of 5 as well. The fund that you are working for purchased one share here, one share or stock, one stock was purchased here, number one was purchased, and one more was purchased here. And both of these stocks were sold here. These two stocks were sold here. What is the percentage return of year 1 and year 2, and then what is the average percentage return of 2 years? There are three numbers that you have to calculate. Percentage return of year 1, percentage return VA2, and then the average percentage return for 2 years. Number of shares. One share was purchased here, another was purchased here, and then these both shares were sold at the end of the 2 years. It's of same company. So obviously the first share was purchased for $50 and the second share was purchased at that time for $60. Now for year 1, we can do this calculation: 60 minus 50 plus 5 divided by 50. That is 30%. Now for second year, there are two ways the calculation can be done. Calculation can be done for the overall investment, or calculation can be done on per share basis. Both will give you the same answer. So I am doing it on per share basis, but doing it for the full investment will give you the same answer. For the second year, it is 90 minus 60 plus 5 divided by 60. That's important, not 50. Because for the second year, the beginning investment was $60. $60 was invested for 1 year. 58.3%. And then using these two numbers, you can calculate average, which comes to 43.47%. Very good.
The average would be the geometric mean.
Geometric mean. Now average, the term average, we will be using the geometric mean, not the arithmetic mean. Very good. Now, investors may not, the investor for which you are managing money may not agree with this calculation. He may say, look, from my side, this does not make sense. What are you talking about? 43.47 average return? That's not my average return. If I look at it from cash flow perspective, outflow, inflow, my IRR is not 43. Can you guess what is my IRR? As investors, the money that I have given you at time 0 and time 1, and then I collected back from you at time 2, use this and calculate IRR. First of all, identify the cash flow. How much money I have to give you at time 0, at time 1, and then at time 2, how much I got back. And just simply calculate IRR. So first identify 3 cash flows. So cash flow at time 0, cash flow at time 1, and cash flow at time 2, and IRR. Cash flow at time 0 is negative 50. What is cash flow at time 1? Now the additional share was purchased, for which money needed to be provided. How much money is needed to buy 1 share? Because the share price is 60, but there is a 5 cash already there. So 55, very good. And finally, the cash that comes out, when 2 shares are sold for $90 each, 180 plus dividend of 5 on each share, which means dividend of 10, 190. Now, in cash flow sheet, these are the cash flows that you will enter to compute IRR. And let's see what it comes out. $47.5. So you activate cash flow sheet, first clear whatever is there, the second function CA, and then you try it. Anyway, those who are calculating, you can do that later on. But let's focus on the number. Let's say the number are correct. Let's focus on the numbers. From investor side, the IRR is 47.54. But the manager is saying, the fund manager is saying, my average return is this. These are two completely different numbers. One is 47, the other is 43. First of all, let's make sure that we know that this is called TWR and this is called MWR. There's a good chance that in exam you will have to calculate these numbers. TWR stands for time weighted return. MWR stands for money weighted return. You will be provided with this story. That's it. That a share is trading at $50 and one share was purchased. By the end of the year, share was trading at $60 and paid dividend of 5. Another share was purchased. By the end of the second year, the share was trading at $90 and dividend of $5 was paid, and both shares were sold. What is TWR? What is MWR? So on this sheet, you can see the complete process of identifying this. So that is one type of testing that can be done. There is another type of testing that can be there regarding these two, and that is which one is better. Now, we are going to learn later on, there is something called Global Investment Performance Standards, GIPS or GIPS. Those standards are developed by CFA Institute, and they require all CFA charter holders that when they are presenting information, it's complex, but the one that is preferred is TWR. It's a level 3 topic in detail. But at this stage, just know how to calculate and remember that this is the preferred one. Time weighted return. So you have learned two things regarding these. One, that how to calculate. Second, which one is better. Third thing that you need to know is that whether MWR will be higher than TWR or lower than TWR. In this case, as you can see, MWR, the wrong one that we should not use, is higher than 43. It will always be the case if more money is invested in the good year. Which was the good year? The year 1 or the year 2? Year 2. Year 2 was the good year, and more money was invested in second year. Because it is money weighted return and more money is invested in second year, so more weight was given to the second year and the average moved up. If the second year would have been bad years and money weighted return had been calculated, then the average would have moved down. Why? Because the money's weight would have pushed down. Money weighted return, because the weight is calculated, gives more weight to the year in which more money is invested. So if it is a good year, then money return will be high. If it is a bad year, it will be low. So that's why this should make sense. If funds are contributed, additional money is invested prior to a period of relatively poor return. Now, which was our case? Our case was the other one. Funds were invested prior to a period of relatively high return. Remember, additional money was invested at the start of the second year, which was relatively a good year. Relative to the first year, it was a good year. In that case, money weighted return will be greater than time weighted return, as is the case with our example, which you have calculated. So these are three things from exam point of view that you need to know regarding money weighted return and time weighted return. How to calculate, which one is better, and whether one will be higher or the other will be higher. So all summarized. So we have discussed NPV IRR, we have discussed money weighted return, time weighted return. Now I am moving to the next page. Now on the left side we have a formula which we have already discussed. P1 minus P0 plus D1 divided by P0. What you get is holding period yield or holding period return by using this formula. On the previous slide we just did that. So this is not a new formula. You can either use this or you can use this. Both will give you the same answer, and we have just used on the previous slide. Now we know the name. The name is holding period return. So I can write something related to the previous slide, and you need to agree whether it is correct or not. Is it a correct formula? 1 plus holding period yield of year 1 multiply 1 plus holding period yield of the second year raised to power 1 over 2 minus 1. This is incorrect because it should be TWR. Very good. Not MWR. Okay. Now another thing that we need to learn is a very important instrument in finance world is known as treasury bill. Okay. In fact, it is the most important. What is a treasury bill? Treasury refers to government and something issued by government, and obviously default is US bonds. A bill represents is a typical certificate, a page, not is electronically, but it used to be a page which would have a value, let's say $100. And government would sell that paper to you. Government would say, for example, give me $90 and get this paper from me. This paper allows you to collect $100 at a certain time. So T-bills are pages that say government will pay $100 on, let's say, 31st December 2014. And government sells these papers for less than 100. So why would you buy this paper? Because this, you buy this paper for $90, you hold this paper, keep it in a safe place for 1 year. At the end of the year, bring that paper back to the government and collect $100. T-bills are extensively used by commercial banks to give loan to the government. So when government wants money from commercial bank, they do not say to the commercial, give us money and we will give you back money. Government says, look, we have this page, we are selling. Do you want to buy? And this page is saying that we will pay 100 rupees after a certain time. Do you want to buy this page? We can sell it for 96. So government will sell that page to the commercial bank and collect 96 rupees. Commercial bank will hold that page till what we call maturity, or at the end, they'll bring that page back to the government and collect 100. So the 4 difference will be their profit. Now, instead of saying that this is the profit that they are earning, we can also say this is the discount that they are getting, because they are buying something worth 100 for only 96. So they are getting a discount of 4, which is their profit. Now, let's say, at the start of the year, you can buy something for a T-bill for 96. A T-bill for 96. and at maturity you will collect 100. Now if I ask you what is the discount rate, clearly it is 4%. Now to make it more interesting, let's modify it. Let's say that this T-bill is actually a 6-month T-bill. So you purchase this T-bill for 96 now, and after 6 months you get 100. Now if I ask you what is the discount rate, you cannot say 4% because the problem is the rate should be for the full year. So we need to say 8%. Why? Because for the full year, the discount rate is 8%. So remember in CFA, whenever the percentage sign comes, except for very few exceptions, it is always for the full year. Even if I am saying 1 month T-bill has interest rate of this, the rate will be not for 1 month. Rate will be for the full year. The rate will be calculated, you calculate 1 month, multiplied by 12. So this is, I'm saying here that I have a discount of $4 or 8%. Okay, why? Because when I'm talking about dollar, I'm talking about the actual discount. When I'm talking about the percentage, I'm talking about the annual rate. So I cannot say 4%. That is incorrect. Whenever I'm attaching the percentage, it has to be annual. But you can see the flaw. There is a problem. This 8% is ignoring the compounding. The $4 can be invested again, so there should be some compounding. So there are various ways to calculate these numbers. Here you have. Look at this. Bank discount yield, RBD. Look at the formula. Discount divided by the face value into 360 divided by time. In our case, we can easily do the calculation. Discount was $4 divided by the face value 100 into 360 divided by 180, and you get 8%. That we did by multiplying by 2. So basically, if you just multiply it by 2, what you get is bank discount yield, and it is not correct. Why? Because it has two problems. There are two problems with this. The word yield will be discussed again in detail. It's a very important term in CFA, yield. But this bank discount yield is not correct. Let's look at another way to calculate this number. How much I'm earning if I invest in this? I'm earning $4 over investment of 96. My percentage return is not 4% because to earn $4, I did not invest $100. This is known as holding period yield, and as you can see, this will be greater than 4%. What is the exact number? 4 divided by 96. 4.17%. This is more realistic. The 4% was not the correct return that I am making. Yes, I am making 4%. No, I am not making 4%. I am making $4 over investment of 96. So a better would be, instead of the discount rate, holding period yield. But the problem is, this is not annualized. And it is unprofessional to write 4.17% because that would be confusing. Because generally percent is for the full year. So we need a way to convert this 4.17% to annual number. There are two ways to do that. Let's see. One is the simple one. Here you see, which is called money market yield. What you do, you take the holding period yield 4.17%, multiply it with 360 divided by 180. But this is still wrong. Why? Because we are not considering the compounding effect. So the correct one is this. The best one. In this, 1 plus 4.17%. Take a note, not 4%, 4.17%. Raised to power, not 360. Take a note, it's not 360. It is 365 divided by 180. 365 divided by 180 minus 1. This will give you effective annual yield. Ji.
Sir, what if we go with effective annual rate?
That is same thing. EAR and EOR same thing. Yeah, they're the same. As you can see very clearly, one big benefit is that it incorporates the effect of compounding. You have some more formulae. If you want to convert this into this, you can use formula. This section is going to be tested numerically. You'll be given information and you'll have to calculate one or the other or the other one. It's a formula to convert one into the other. The significance, the logic is beyond, we do not need to worry about that. Because you'll be working as assistant to the assistant portfolio manager. After passing level 1, your job profile will be that you will be assisting the assistant portfolio manager. So you won't be involved in a lot of the theoretical discussion. Your role will be, someone will say, go and calculate RMN, go and calculate RBD, go and calculate EAY. No one will talk to you why you are doing that. But once you reach level 2, that is where you are going to learn in more detail, because then you are getting prepared to be assistant portfolio manager. In level 3, you will be trained to be a portfolio manager. And then you will come back to these topics and learn in more detail that why we are doing this. But from exam point of view 1, you need to know how to calculate these 3. Though they actually, here you see 3, but there is a hidden one, and that is the 4th one, the HPY, because which is an input to the other 2. So these are 4 measures that you should be able to calculate, and so that is number one, objective number 1. Second objective is you need to be able to say what is wrong with RMN. The RMN, this is the money market yield. I am making a statement and you need to identify correct or incorrect. The RMN, money market yield, is not the preferred measure because it is based on face value. Correct or incorrect? RMM, the money market yield, is not preferred because it is based on face value. That is incorrect. Very good. Why? Because it is not based on face value. It is based on holding period yield, which is based on the denominator. You have the actual investment, 96. Okay, let's try another. The RBD, the bank discount yield, is not preferred because it fails to consider compounding. True. Now, bank discount yield has 2 problems. One, it fails to consider compounding, and the other problem is that it is based on face value. Because we are saying that 4%, the discount is being used as 4%. You see, we are saying $4 divided by $100. But that's not what our investment is. We are earning $4 over investment of 96. The problem is, in US, as I mentioned, mostly bonds pay coupon 6 monthly. So, if a 6 monthly coupon paying bond offers 10% coupon, a 6 monthly coupon paying bond offers 10% coupon. You know and I know that effectively this 10% will be converted into, yesterday we did the calculation, effectively this 10 will grow to in a year because you are getting the opportunity to reinvest. So this 10% will compound to, yesterday we did it, 10.25%. We know that if in a bond you get 10% every 6, divided into 5%, you can compound it to 10.25. So if you are looking at a sheet that says this bond pays this, bond B pays this, bond C pays this, bond D pays this, and there are numbers appearing, 10%, 11%, 13%. You get a similar sheet from London, and it says bond number A is paying this, bond number B is paying this, you get a similar sheet from Frankfurt, or you get Hong Kong. So you are comparing which bond to invest in. You need to be warned that the sheet that you got from US, the number that they are appearing are not annual rates. So that's why that sheet will say at the top what we call bond equivalent yield. To warn you that these are with 6-month coupons. So do not compare these with the sheet coming from London or Asia. Because when they say 10%, that is all you get. You do not get the opportunity to reinvest. While this 10% means that you will get the opportunity to reinvest. So a term that you need to understand, bond equivalent yield, BEY, basically is a rate that pays coupon 6 monthly. So if I provide you this information that a bond is of face value of $1,000, which has recently paid coupon of $75. I am not saying anything else. I'm only saying it's a bond. It's a US bond that has face value, which means you have to invest $1,000 to get this bond, and it has recently paid coupon, I'm using CPN for that, coupon of $75. And I'm asking you to calculate EAY and BEY of this bond. Now I have not said that this is a 6-monthly coupon paying bond, but this is by default. By default, you need to know as a CFA level 1 candidate that a US bond will pay interest every 6 months. Recently, it has paid interest of $75. What is EAY and what is BEY? Sorry? 15.56 and 15. As you can see, $75 divided by $1,000 is 7.5%. So $75 divided by 1,000 is 7.5. And for BEY, all you have to do is multiply with 2 and you get BEY. But in order to convert into EAY or EAR, you have to do some other calculation. This the way we yesterday converted 10% into 10.25%. That 10% was BEY and that 10.25% was EAY. And we use a formula to convert that. That is on the second page of the previous reading. Actually, the way you will do that is 1 plus 15 divided by 2 raised to power 2 minus 1.